achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war, when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today, because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices, because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. If you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, Sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I said, I'm going to borrow everything I can. And that creates a demand for funds, and interest rates go up. And then the recession hits, and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards, they stop doing loans. And then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is, they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot. To say that there could be a rate cut, maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. I can tell you exactly what the Fed's going to do, and you can do this at home. So if listeners want to take notes, it's really easy. First of all, what is the problem the Fed's trying to solve? What is their solution? And then what are the exceptions to that so that we can have a complete predictive analytic model? The problem they're trying to solve is the following. We know from a long series of experiences, 30 or more business cycles since the end of World War II, that when the U.S. is in a recession, you have to cut interest rates 3 to 4% to get the U.S. out of a recession. You need 300 to 400 basis points of cuts to get the U.S. It's like a plane heading for the ground. How do you pull it out of a nosedive and get it back up in the sky? The answer is 300 basis points of cuts. How do you cut interest rates 300 basis points when you're only at 75 basis points? The answer is you can't. And forget about negative rates. The evidence is now pretty good that negative rates do not work. In other words, negative rates are not more of the same. When you go from, let's say, a half of 1%, then you go to a quarter, and then you go to 0, and then you keep going to negative 25, you didn't just ease by another 25 basis points. The evidence from Japan and Europe is that you're through the looking glass and you have very strange effects, really unintended consequences. I'll give you a couple examples. So the conventional theory is, well, the more I cut interest rates, the more stimulus I get. That's a joke, but that's what they think. But if I go negative, you're absolutely going to go out and spend the money. Because if you don't spend the money, I'm going to take it away. You sit there long enough, you'll have nothing left in your bank account because I'm going to take, with these negative interest rates, I'm going to take it away. So people will run out and spend. And the other thing is that, it's obviously, from the lending point of view, they'll borrow money, because the bank pays you to be a borrower. But here's what happens in the real world. This is the difference between academics and human beings. When people see negative interest rates, people have goals in mind. They have lifetime goals, right? They want kids' education, parents' health care, their own health care, retirement. If you start taking their money away with negative rates, guess what they do? They save more. They're like, hey, I got to put my kids through college. You're taking my money away. I better save more. And then what kind of signal is the central bank sending with negative interest rates? They're sending a deflationary signal. So people go, well, if you think it's going to be deflation, I'm not going to spend money. I'll wait till the price comes down. So you're trying to encourage lending and spending. And what you get is more savings and no spending, deferred spending. You get the exact opposite of what you want. So again, another egghead experiment gone awry.
But the point being, so negative rates don't work. So zero bound really is zero. It really is a boundary. And, Bernanke has said this in his recent writings, and I think he's right about that. So back to the problem. How do you cut interest rates 300 basis points when you're at 75? Well, the answer is you can't. So you have to raise them to 300 basis points. So the problem the Fed is trying to solve is how do they get rates to 3.25% before the next recession? Now, I'm not saying the Fed sees a recession, and that's easy because the Fed never sees a recession. In 102 years, the Fed has never seen a recession, never forecast a recession. But they know their economic history. We are 8 years into an expansion. It feels punk. I mean, the growth is anemic, but labor force participation is low, productivity is dropping. There are a lot of bad things going on. But in fact, we are in the 8th year, actually coming up on, soon be entering the 9th year of an expansion, which began in June 2009. Right. By the way, you have a hard time convincing most Americans that we're not still in a recession. Depressions are different than recessions. The technical definition of a recession is 2 consecutive quarters of declining GDP with rising unemployment, a couple other bells and whistles, little subjective factors, but that's basically it. So people, when you say depression, they're like, depression sounds worse than a recession. And if recession is 2 quarters of declining GDP, then a depression must be like 10 quarters of declining GDP because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting closer to the next one. So they are in a desperate race to get rates up to 3.5% before the next recession hits so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. Why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped a whole cycle. He skipped a whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really 2 technical recessions, 29 to 33, and then 1937-38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. Doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't. So Janet Yellen now has to make up for lost time. So that's the mission. But again, and this is what the market completely does not get. And the Wall Street economists don't get. Nobody gets this because they see the Fed raising rates. And they've done the correlations and the regressions back to World War II. And they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger. So bid up stock prices, et cetera. But that's like saying umbrellas cause rain. In other words, they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going and unemployment starts to go down and industrial capacity utilization starts to go up and inflation starts to go up and the Fed's watching. And then it keeps going. They go, oh, it's getting a little hot. We better raise rates. And they raise rates. But of course, they started too late. The expansion keeps going. Inflation keeps going up. Unemployment keeps going down. Then the economy starts to cool down. Unemployment goes up and then prices go down and capacity utilization drops. And we get into recession like, we better cut. Then they cut. And then you hit the bottom and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brains on Wall Street, they've got all this data and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for like 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped a cycle and they're playing catch up. For the first time since 1937, the Fed is tightening into weakness. That's a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019 until they get them to 3.25%. So like clockwork, every March, June, September, December for 2017, 2018 into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're 3.25. If we have a recession tomorrow, we can cut them back down to 0 again and get out of it. That'll be mission accomplished. Now, this is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to a Fed rate hike? Under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September, and they didn't lift off in September because the Chinese rate exchange devaluation, the stock market fell out of bed August 2015. Finally, they raised them in December 2015, and Wall Street was ready for March. I said no, in June, no, September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are 3. Well, 4 actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed as their scenario, or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs. So Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points in a disorderly way, it looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation has been decent, over 100,000. Disinflation is probably coming, but not quite here yet. And they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple.
So a couple of things. We should probably, without taking too much for granted, we should probably just define BRICS. It's an acronym: Brazil, Russia, India, China, South Africa. So those are the BRICS. And started in 2002 as a Goldman Sachs marketing gimmick. Jim O'Neill and some partners came up with it. And all they did, I'm not diminishing what they did, but they kind of took the leading economies, took out the G7 and Switzerland and a couple obvious leaders, and said, well, who's left? That will be the up-and-comers, the fastest-growing developing economies. And they got Brazil, Russia, India, and China. That was kind of easy. And then a few years later, they added South Africa, which was a little bit of a favor to South Africa. South Africa is not anywhere near as large as those other economies or as important. However, it is one of the biggest economies in Africa. And if you're going to be the BRICS, you probably can't just be South America and Asia. You probably need to include an African country. So they picked South Africa. So for a couple of years, it was a Goldman marketing brochure. But then in 2006, at the United Nations General Assembly in New York, annual meeting, heads of state and foreign ministers show up from all over the world, but they have what they call these bilateral meetings on the sidelines. And sometimes there are 3 or 4, say, hey, we're all here, let's just grab a conference room and sit down and talk. Well, Brazil, Russia, India, and China, they sat down and they said, yeah, we actually have a lot in common, a lot to talk about. And we added it up. We're a pretty powerful group. So they formalized it. And then in 2009, they had a summit conference, a formal summit conference with an agenda and all that in Yekaterinburg in Russia, in the Russian Federation. And they solidified, okay, we're a group, we're going to work together. And they did. And over the coming years, they multiplied numerous. People say it's the BRICS meeting. They have about 190 meetings a year. They have working groups on women's rights, sports, the environment, climate change. You could go on and on. It's a very active, what they call secretariat, which is central organization. A few years later, in 2014, they formed what they call the New Development Bank, NDB. Well, what's the New Development Bank? First of all, it's got 100 billion of capital, part paid in, part callable, but it also has borrowing power with that kind of ownership and that kind of capital on the balance sheet. They've got hundreds of billions of dollars of borrowing power. They could easily get a pretty good credit rating. And the purpose is to make loans for development projects to the member countries. And by the way, there are stockholders of the New Development Bank who are not BRICS, but they're kind of in the club. Well, what does that sound like? The World Bank on their own terms with their own governance. Okay, the following year, they created something called the Contingent Reserve Arrangement. Well, what's that? Again, they threw in a couple $100 billion from the members. China was the biggest contributor. Again, with borrowing power, so take a couple $100 billion times 5 or 10, that's your power. And this institution was designed to be a swing lender to members who were running trade deficits or facing a run on their currency or facing the prospect of having to close the capital account. Exactly what we saw in 1997, 98, by the way. I was there for that one. We ended up with long-term capital. Well, a pool that is a swing lender to countries with balance of payments deficit, what does that sound like? That's the IMF. So basically, they copied the World Bank, they copied the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They're very methodical. So they duplicated the World Bank. They duplicated the IMF. Now they have applicants for membership. And there are, I think, 21 or more countries who have applied. Well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted, starting with Saudi Arabia. Okay, so what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have two of the three largest nuclear arsenals in the world, Russia and China. You have, throwing India in and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is, I learned development economics in the 1970s. We had something called the third world. It was Russia or, Soviet Union and the US. And then there was the third world. And all you knew about them was they were poor and, you had to get them off the runway. We actually had the runway theory of how you'd grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military. And again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, this goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics, some, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, led by China. And these are mostly Central Asian republics, including Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of two. Russia's the only country in the world that's a member of all three. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this thing plays out, and I'll talk about the thing, I realize we're glossing over that, but when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, okay, here's the BRICS, it's 5 countries or whatever. Well, here are the applicants, it has another 20. And here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going. And all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island, what he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is, more collective economic and population power? By the way, output of wheat, pick your metric. This dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Let's just kind of digress for a second. And what are the headlines saying? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? And Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Now, Russia sells oil to China. China pays in BRICS, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem.
into an expansion. It feels punk. I mean, the growth is anemic, but labor force participation is low, productivity is dropping. There are a lot of bad things going on, but in fact, we are in the 8th year, actually coming up on soon be entering the 9th year of an expansion, which began in June 2009. Right. By the way, you have a hard time convincing most Americans that we're not still in a recession. Depressions are different than recessions. The technical definition of a recession is 2 consecutive quarters of declining GDP with rising unemployment, a couple other bells and whistles, little subjective factors, but that's basically it. So people, when you say depression, they're like, depression sounds worse than a recession. And if recession is 2 quarters of declining GDP, then a depression must be like 10 quarters of declining GDP because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting closer to the next one. So they are in a desperate race to get rates up to 3.5% before the next recession hits so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. Why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped a whole cycle. He skipped a whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really 2 technical recessions, 29 to 33, and then 1937, 38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. Doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't. So Janet Yellen now has to make up for lost time. So that's the mission. But again, and this is what the market completely does not get. And the Wall Street economists don't get. Nobody gets this because they see the Fed raising rates. And they've done the correlations and the regressions back to World War II. And they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger. So bid up stock prices, et cetera. But that's like saying umbrellas cause rain. Because they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going and unemployment starts to go down, and industrial capacity utilization starts to go up, and inflation starts to go up, and the Fed's watching, and then it keeps going. They go, it's getting a little hot. We better raise rates. And they raise rates, but of course they started too late. The expansion keeps going. Inflation keeps going up. Unemployment keeps going down. Then the economy starts to cool down. Unemployment goes up, and then prices go down, and capacity utilization drops, and we get into recession. Like, we better cut. And then they cut, and then you hit the bottom, and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over, 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brands on Wall Street, they've got all this data, and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for like 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped a cycle and they're playing catch up. For the first time since 1937, the Fed is tightening into weakness. That is a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019, until they get them to 3.25%. So like clockwork, every March, June, September, December, for 2017, 2018, into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're at 3.25. If we have a recession tomorrow, we can cut them back down to 0 again and get out of it. That'll be mission accomplished. Now, this is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to a Fed rate hike? Under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September, and they didn't lift off in September because the Chinese rate exchange devaluation, the stock market fell out of bed August 2015. Finally, they raised them in December 2015, and Wall Street was ready for March. I said no, in June, no, September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are 3. Well, 4 actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed as their scenario, or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs. So Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They've missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points in a disorderly way, it looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation has been decent, over 100,000. Disinflation is probably coming, but not quite here yet. And they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple. The inflation peaked around 9%, but it has been coming down. It's still too high.
It's still way above the Fed's target. They say we want 2%, but I've never felt that 2% was the right target for inflation. I always thought it should be zero. If you believe in price stability, you wouldn't want any inflation and you wouldn't want any deflation. You would want price stability. Now, of course, you're never going to get it exactly there, but the target in that world would be zero, maybe a little bit below, a little bit above, but you'd always be steering to zero. That means you're not stealing anyone's money through inflation. You're not enriching creditors through deflation. You're not distorting the allocation of capital by either one. You're just saying we want stable money. That's kind of the Fed's job. Then the question is, why is it 2%? And, I disagree with Milton Friedman on a lot of things, but Milton Friedman said zero. He didn't think it should be 2%. He thought zero was the right number. I agree with that. So why is it 2%? Well, the Fed has a rationale. The rationale is every now and then you have to cut interest rates to stimulate the economy, bail out the stock market. You just need a rate cut. And the evidence is pretty good that negative rates don't work. They have been tried for years in Japan, Switzerland, I believe Sweden for a while, and the ECB, but they don't do anything. They don't stimulate. In fact, they often do the opposite of what they're intended to do. Let me give you a concrete example. So the idea is if I cut interest rates, lower and lower, as a saver or an investor, I'm going to say, well, I don't like those low yields. I put money in the bank. I only get, a quarter of 1% or half of 1% or whatever. So I'll go buy some treasury notes or I'll go buy some stocks. And that's called the portfolio channel effect. In other words, by keeping rates so low, you make simple savings and liquid investments unattractive, and you drive investors to other investments, housing, stocks, bonds, whatever, commodities perhaps. And then that creates a wealth effect. And if my assets go up, I feel more prosperous, and maybe I spend more money, and that helps the economy, et cetera, et cetera. That's the theory. It's all garbage, by the way. There's very little evidence for the wealth effect. I mean, assets go up, people feel a little better about it, but the idea that they turn around and spend more money does not hold up. The people with the most assets tend to have the most discretionary income. And, once you got a couple of cars and a couple of houses, and a decent wardrobe, you're actually going to go spend more money. Well, probably not. You'll probably save it or invest it. I'm not saying those are bad things, but the idea that it stimulates the economy is not true. But if you follow the theory and say, okay, lower rates force you into asset purchases, et cetera, wouldn't negative rates do even more of that? Because what happens with a negative rate? You have $100,000 in the bank and at a negative 1% interest rate. I'm the government or the treasury or the bank. I'm taking $1,000 a year. I'm taking 1% out of your account. So you're sitting there. You just say, hey, I just want to save $100,000. That's all I want. But with a negative rate, it goes 99, 98, 97. And the idea there is, well, now you're really going to spend your money because it's kind of use it or lose it. Again, these are kind of theories, but let me kind of ground that in the real world a little bit. What do people actually think? When they see negative rates, people say to themselves, there must be deflation coming. The economy must be in really bad shape. Deflation must be getting the upper hand. Why else would they go to negative rates if they weren't worried about deflation? And if they are worried about deflation, and they are, then I'm going to save more. Far from getting people to spend, remember, the dollar is worth more. In a deflationary world, your dollars are actually worth more. In real terms, a dollar can be, just a bank account, can be your best performing investment. In a deflationary world, if you have 2% deflation, then the real value of a savings account with zero interest goes up 2%. And that's probably better than what stocks are doing in that world. So people act rationally. They say, okay, we have negative rates. Central bank must be worried about deflation. If they're worried, I'm worried, and I'm going to save more because, first of all, those savings will do well in deflation. I need to be prepared for that. The last thing I want to do is spend. If prices are going down, why would I spend? I'll wait 6 months, get a cheaper price. So, in other words, real world behavior is the exact opposite of what central bankers predict. Central bankers predict, use it or lose it, you'll go spend the money because I'm going to take it away. But real people say, no, I'm going to save more because you're signaling to me that the value of the money is going up because you're worried about deflation. The prices are coming down, so what's the rush? So for all those reasons, negative rates don't work. Now, in theory, cutting rates from 5 to 4 to 3 to 2 down to 0 does perhaps have some stimulative effect, not as much as people think. And so the Fed says, well, we don't want to start with zero. If we start with zero, if that's our target, and negative doesn't work, and the economy goes into a recession, how do we stimulate the economy? We can't go below zero, but we can't cut rates because we're at zero. So they believe that they ought to keep rates around 2%. Now, as inflation is about 2%, interest rates are about 2%. And that gives you 2 points of cuts. You could do in 25 basis point rate cuts, you could do 8 cuts. It's a full year of rate cuts from 2 to 1.75, 1.5, 1.25, et cetera. You could do 8 25 basis point rate cuts with 2%. So the Fed says our target rate is 2% because we need a little cushion in case we have to cut. And if we're at zero, we don't have a cushion, we can't cut. That's what they say. The reality is the following. And the way I explain this, it's like a little kid, like a 9-year-old kid, and his mother leaves her purse around. And the kid goes in the purse and sees there's $50 in the purse. And he says, well, even an 8-year-old will say, well, if I steal the $50, mom's going to catch me and I'm going to be in trouble. But if I take a couple bucks, she won't notice. Like, she's not counting the dollars every day. And the Fed's idea is if I steal 2% from you, you won't notice. 10%, yeah, you'll be up in arms. You'll be driving tractors up the steps of the Fed the way they did in 1980. But 2%, you kind of won't notice. Well, what's the math of 2%? Well, 2% cuts the value of the dollar in half in 35 years. It cuts it in half again in another 35 years. Bear in mind, you're starting from down half. So in a typical lifetime of 70 years, at 2%, the dollar is going to lose 75% of its purchasing power. So in 70 years, typical lifetime, your dollar loses 75% of its purchasing power at 2%. And that's really the point, because 2% year in, year out, probably not enough to feel, but it's insidious. And by doing it for a long enough period of time, you destroy the purchasing power of the dollar. And that's what they really want to do. Why? Because the federal debt is nominal. The debt is nominal. If I owe you $1, I owe you $1. Whether in real terms it's $1.05 or 95 cents, that's separate, but I owe you the buck. Well, if you can destroy the purchasing power of the dollar, you're actually reducing the real value of the debt. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I've destroyed the value of the dollar. Now, 3% will do it in about 23 years, which means that you'll destroy 75% of the purchasing power in 46 years, not 70 years. So on, 4%, 5%, et cetera. At 10%, you cut the value of the dollar in half in 7 years. People like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft, in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. So now back to the BRICS. They replicated the World Bank. They replicated the IMF. Now they're coming out with a new currency, BRICS currency. Now, here's where it gets really interesting. And I tell people, I said, if you want to understand this, it took me a long time to figure this out. I was just like slaving over it. But I said, if you want to understand this, you have to stop thinking like an American. You have to start thinking like a Russian. This is the kind of thing that pretty much only Russia could come up with. So what is the BRICS currency? And by the way, I don't know if they're going to call it a brick. I'm saying brick for convenience. It doesn't matter what they call it, but I just call it a brick for the time being. But they'll come up with a name. Who knows? The value of the brick is not determined with reference to any other currency. It's determined with reference to gold by weight of gold. And I don't know the weight. They'll pick one. But again, it doesn't matter because now we're back to Aristotle's transitive law. This is the key. This unlocks the whole thing because Aristotle said, if A equals B equals C, then A equals C. The B can drop out. It's not even arithmetic. It's logic. It's called the transitive law. I'm certain that Aristotle invented it. If any Greek scholars know an earlier source, let me know. So what the BRICS have done is they have dodged the biggest bullet, the thing that caused Bretton Woods ultimately to fail, the thing that potentially stands in the way of all this. They've defined their currency by weight of gold. Now, a weight of gold has a dollar value, right? So A equals B equals C. One brick equals one, could be an ounce or a kilo, doesn't matter. Call it an ounce. One brick equals 1 ounce of gold equals today, 1970. Well, through the transitive law, drop out the B and one brick equals 1970, $1,970. But that's constant. I mean, that logic works for a moment in time, but it's not fixed because the price of gold is going to fluctuate daily, minute by minute, right? So what's going to happen is the dollar gold, call it exchange rate, the dollar price of gold. So the LBMA, the COMEX, the London Metals Exchange, JP Morgan unallocated forward contracts, the whole huge gold market in dollars is still going to exist. In fact, the BRICS want it to exist. And if I could just digress for 1 minute, I've never seen an international monetary economic problem that has created more confusion. I won't say misinformation, that's a little trite, but just confusion or maybe deliberate hyperbole than this one. Because let me tell you what this is not. I'm going to tell you what it is, but it's important to know what it's not. This is not the petro yuan. This is not the petro ruble. This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world. It's not any of those things, but that's what everyone's running around on websites or whatever shouting about. It's none of those things. In fact, quite the opposite. And this is where the Russian mentality comes in. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride. By declaring one brick equal to a weight of gold, again, weight's the key, they just let the dollar gold market go wherever it goes, and the brick is worth an ounce or whatever, kilo, whatever. And yeah, the dollar equivalent under the transitive law changes, but they're not pegged to the dollar. They're not fighting that fight. In other words, the BRICS get to free ride on the dollar gold system, and they want that system. They don't want it to go away because they get the benefit of a gold value. Now think of what the BRICS don't have to do in this scenario. They don't have to buy gold. They don't even have to own gold. They do, but no one in the world has enough gold to back a currency. This currency, the BRIC, will not be redeemable into gold. Now maybe there's a dealer somewhere who will take it. That's between you and the dealer. But it's not like you're going to be able to march down to the People's Bank of China with a pile of bricks and say, give me the gold. They're not going to do it. So it's not redeemable. They're not going to make a market. They're not going to maintain a value because they don't have to, because it's by weight. They just get to sit back and piggyback on the dollar gold system and let the dollar do all the dirty work with one twist. And here's the Russian contribution. So you don't have to close your capital account. You can close it, open it, whatever. You don't have to buy gold. You don't have to make a market. You don't even need that much gold. You just say, this is the ultimate fiat currency. The word fiat in Latin means I say so. Well, they say so, and there it is. Basically, this is a bet. This is a bet that the dollar is going to collapse against gold over time. I think that's a very good bet. This is not a 3-month forecast. I'm not saying gold's going to go up or down the next week. Who knows? But over time, now we're into what? Debt to GDP ratios, annual deficits, dare I say, modern monetary theory. I mean, all these ideas are ruining the dollar, and everyone can see it, but not yet. And so if you want to launch this new currency and you say, hey, long term, the dollar is going to collapse in terms of gold, I'll hook my horse to this wagon called gold by weight, and I'll just reap the benefits. And I don't have to do a thing. And so that you're defining it by weight. So the dollar gold market goes where it goes, but you don't really have to worry about it because you're anchored to weight. But here's the twist. And this is how it's going to play out. Now you're the United States. You're like, looks like I've been painted into a corner. What can I do? Well, one of the things you could do, I've told the Treasury this for years, they don't listen. I mean, they invite me in, but they don't listen. One of the things you could do is buy gold. But what happens when the United States buys gold? The dollar price of gold goes up, and the brick gets stronger, and the dollar gets weaker. Checkmate. In other words, the U.S. is now in a box where you can't even get out of it by buying gold, because you're going to weaken your own currency relative to gold in the process, and the BRICS are just going to sit there and not lift a finger. So it's genius. I got to credit the Russians. I'm not saying the Chinese couldn't think of something like this, but this has got Russia's fingerprints all over it. Okay, people have been talking about this for 20 years. The Great Reset, the end of the dollar, the collapse of the dollar, gold to the moon, et cetera. And it's never played out. And the reason, or some of the ones, which is the dollar has these huge embedded advantages in the form of its reserve currency status, not because everyone loves the dollar or they even love the United States, but because we have the only bond market big enough to absorb global savings. The US Treasury market is huge, it is liquid, but it's got a whole infrastructure. Primary dealers that bid at auction, when issued trading, settlement, clearance, futures hedging, options hedging, depository trust corporation, settlement, on and on and on. It's got this huge infrastructure of laws, rules, and regulations that they've been building for a long time. I would say 37 years since Alexander Hamilton. But above all, it has the rule of law that people just trust it. Don't have to like the dollar, don't have to like the United States, but you trust the market. The U.S., in response to the war in Ukraine, broke the trust. They froze the U.S. Treasury assets of the Central Bank of Russia. Unprecedented. And I'm a sanctions expert. I work for the intelligence community. It was part of what I did was, look at sanctions and CFIUS and a lot else. And as far as I'm concerned, and I know that our BRICS friends agree, that's a default. Maybe S&P would call it a selective default, but Russia made the money. They bought the treasuries. They're entitled to principal and interest. And we're saying, no, you can't have the principal and interest. We're not paying you. Well, that's a default. I don't care how Janet Yellen wants to dress it up. And it was a shock. But worse than that, everyone else in the world was watching. Saudi Arabia, India, Brazil, Malaysia, and they're saying, and Turkey and others, and they're saying to themselves, what if the United States doesn't like what I did? What if they don't like my policy? Are they going to freeze my treasuries? Well, until a year ago, you would say, well, of course not. They would never do that. Well, they did in the case of Russia, and they will potentially in the case of these other countries. So that was the catalyst. The idea of getting out from under the dollar, yeah, it's been around a long time. The feasibility of that was limited, capped really by the absence of a bond market big enough to absorb global savings. But now the countries are saying, well, what good is it to have my savings in treasuries if you're just going to steal them? So I'm not saying BRICS are wonderful out of the gate, but at least it's not dollars. At least it's not maintained on a digital ledger at the U.S. Treasury, and at least you can't steal it. And so that was the catalyst that drove this thing from a 17-year project to, hey, warp speed, let's get it done. How do we do it? And there we are. People hear the government say, the economy's fine, or, unemployment's near an all-time low, which actually statistically is true. And they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4. The propaganda is positive. We can talk about that in a little more detail. The reality is harsh, and reality wins. And there's a very good book on this by Robert Shiller, Nobel Prize winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, we got all the models and Phillips curve and wealth effect and various quantity theory money, and some have a place, some are more valuable than others, but don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SCIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. Well, what Shiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time. But it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was "Happy Days Are Here Again," and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to deliberations among White House officials, some of the stuff leaks to the press, and I know some of these people, it's like the economy's great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. The point is, they're inside the White House, they're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is where I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing on federal lands. Handicapped the fracking industry, took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the U.S. energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And so he wants to reopen leasing. I said they shut it down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere. And we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021. And then Biden came in and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted, but don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the US has very little to do with Putin and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It won't happen. We don't have time to go through all the physics of it. Output of energy by weight, gasoline compared to batteries and the pollution of batteries and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. Narratives are powerful, but reality is more powerful.